Harsha Upadhyaya joins us. Harsha, my analysis in the morning was the following, which is that economy is incrementally improving, liquidity has improved substantially, and the sentiment has changed dramatically. So what does this mean for long-term investors? Because economy is not going to recover in a hurry. Sentiment and liquidity, they both have improved dramatically. So are stock markets really running ahead of themselves once again?
Good morning, Nikunj. Clearly, I agree with some of your observations. Sentiments have improved and liquidity has also improved post the tax rate cut announcements. Having said that, the fundamentals will take time to really start showing better numbers. So to that extent, I think it's going to be a consolidation phase. In case there is a lot of momentum based on sentiments and liquidity, I think one should be careful, because this is the time where even some of those which are not going to be benefited by some of the fundamental drivers will likely move up. But one needs to be cautious that it will take time for fundamentals to improve, and hence look at it as more of a investment phase rather than trying to really take more risk and look for short-term gains.
What are you proposing one should do now? Get realistic that, look, economy, the worst is behind us, but we are not going to flourish, we are not going to prosper. Markets are no longer beaten down and bombed out. Good individual stocks like a Maruti or a iShare, all of them are up 35 to 40% from the recent lows. Do you think markets are now fully priced and any incremental uptick will only be a function of data and economic evidence rather than hope, hype, liquidity or momentum?
I would tend to agree on those for at least the large cap basket, but mid and small cap basket is clearly giving more relative valuation comfort, and that's where you will probably end up making more money than the large cap over the medium to long term. And we have been suggesting investors to increase a little bit of allocation towards mid and small cap. And even within our portfolios, wherever the investment mandate allows, we have been buying mid and small cap stocks across sectors. It's not that a particular theme or a particular sector is doing well in the mid cap basket, but there are companies across sectors where the fundamentals have kind of been steady, and also we have seen a good valuation correction over the last 2 years, and that's the area where one needs to increase allocation to.
Okay, I just want to check in on what some of the auto stocks actually may be doing in trade, because a couple of those sales numbers are trickling in. So Tata Motors, the passenger vehicle sales are up a solid 62.6% on month-on-month basis. Remember, from this month onwards, even that low base effect kicks in, which is why the percentage jump may actually look a lot more bloated as the real figure. Eicher Motors RE sales were up about 20% on a month-on-month basis, and Ashok Leyland is going to observe about a 0 to 12 non-working days period in the month of November. Having said that, when it comes to auto sales, they're posting a very mixed set Motown so far, at least. So Ashok Leyland Maruti sales figures have actually disappointed. Bajaj Auto yet again has managed to top the street estimates. That's exactly how Motown has so far fared in the month of October. Harsha, what's the takeaway from autos? Because, the sales trajectory is one story, but what the stocks have done and the way they've lifted off from their low just about or about a month and a half back, that's a completely different story.
Yes, Aisha. If you look at the sales, the wholesale sales have been slightly better or slightly lower than already subdued expectations across the street. But what is hurting is the kind of retail sales numbers that we have seen across segments, which shows that inventory in the pipeline or inventory at the distribution level is going to be a lot lesser post the festive season, which augurs well for the industry. Having said that, most of these stocks have already seen a sharp pullback from the lower levels that we had witnessed maybe a couple of months back. So to that extent, one has to be cautious in terms of what valuations some of these stocks are trading, and whether the improvement in retail sales numbers that we saw, whether that will continue into the next few quarters or not. We would rather be more positive on the two-wheelers than commercial vehicles or passenger vehicles at this point of time because of the relative valuation comfort.
Green is absolutely green, with the exception of Yes Bank, where it's anyone's guess, what will happen today, what will happen tomorrow. Vodafone is up 8%, SAIL is up 2%, Adani Power is up 4%, Jindal Steel is up 4%, Vedanta is up 5%, State Bank of India is also 1%, and Bharti Infratel is also at 213 rupees. Harsha, purely as an investor, would you be tempted to buy telecom? I mean, the only name there is Bharti, but without getting into Bharti specifically, you cannot have a situation where Indian telecom sector will be dominated by just one player. I mean, government will never allow monopoly to happen. If that is the case, then the incumbent players either would be given some dole out or some benefits so that they can survive and revive their balance sheets. So if you think that telecom sector in India will not be a monopoly, that means good news is coming for incumbents. Would you use that logic to buy into telecom stocks?
Nikunj, as you said, this may be a question of survival for some of the players, and hence there may be some dole-outs, but it doesn't mean that they are going to earn a lot more than their cost of capital on a sustained basis. So that's been our view. So only if we find that whether it is a telecom player or any other business, the companies on a sustainable basis are going to earn more than the cost of capital, then we are fine, we'll evaluate it. But otherwise, we'll let it go.
Harsha, when do you think the overhang for some of the NBFCs will get lifted? Will it be resolution of DHFL, Yes Bank or Piramal kind of an issues, or NBFCs will remain under pressure? The winners have been identified by the market, and the fragile state of NBFCs will remain like this. So 2-3 NBFCs, 4 NBFCs, Harsha will do well, but rest of the pack will look weak. What is your sense?
The leaders will continue to do well. I think it's been best of the both worlds for them. They have got ample liquidity, and also they have got benefit of lower interest rate at this point of time. And also in terms of the growth trajectory, the entire runway is empty, and they can cash in on that. For the rest of the NBFC pack, it's going to be a slow grind. I think they need either some large asset sale or some strategic investor coming and putting in more money. And along with that, we also need to see reduced number of negative news flow for the sector. And our view is maybe over a next couple of quarters, the negative news flow that we have been seeing for the last 1 year will start to reduce. And that should give a little bit of more confidence for everybody, including investors and the NBFCs themselves.
Harsha, what is the right way to look at the surge in telecom? Is it a new sector which has got created and everyone's drawn to it, or there is merit in buying life and non-life companies both? And do you own insurance companies?
We do own insurance companies at a point of time where some of the lending businesses have got completely disrupted. To make up for the weight of financials in the overall portfolio, a lot of investors have moved towards insurance, whether it is life or non-life. I think from a penetration perspective and what kind of growth trajectory can be there for some of these companies over the long term, there is absolutely no debate. Yes, the valuations have been high, given the fact that some of the money that was getting invested into NBFCs or some of the PSU banks has moved towards these companies. So one needs to be a little cautious about the valuations, but otherwise I think these are very good businesses to be invested into.
Harsha, what's been your reading of the earnings so far, and what really has stood out for you?
Harsha, clearly this quarter earnings have been slightly better than expectations, but mostly it's been because of the tax rate cut impact that we have seen across many of the companies. Barring that, the business performance hasn't really improved that much. So I think it's status quo for the business performance. We'll have to wait and see how that unfolds over the next couple of quarters. But clearly the tax rate cut has given a boost to earnings in many companies.
All right. What about metals, Harsha, given the kind of spark that we're starting to see across the board there, perhaps on the back of what's happening globally, but we're definitely seeing a little bit of momentum building up. Would you look at some of these names, at lower levels? You feel they've bottomed out? What would be your take there?
We have bought into some select metal names in the recent past. While the fundamental issues will take time to resolve, we've thought that the valuations have more or less discounted some of those negatives. And from that perspective, we have built some small position in metals. We'll continue to hold on to that. Any recovery in price will definitely improve the stock performance going forward. At this point of time, at least the domestic demand has been quite steady. We have been facing issues in terms of the prices, which are led by global factors for most metals, which have been on the downtrend. But once that starts to stabilize, I think the stock performance can be much better.
Only challenge is that everybody has gone wrong in judging their view on the economic recovery. Economic recovery was supposed to happen in 2016 or 17, where metals, cement, industrials, cyclicals, they were supposed to make a comeback. And that is only getting delayed and delayed and delayed. And given where the corporate balance sheets currently are and how there is stress at individual promoters, what makes you convinced that the cycle will turn at the capex level and which will stroke the demand for steel and cement? Because cement, I know, is a large holding, and when you say metals, I'm assuming that you would be betting on a recovery, that's why you're buying metals.
If you look at the recent demand numbers for both these sectors, if you leave out the last couple of quarters, the numbers have been really steady. There has been a growth in domestic demand for both these segments, and that is on the back of lackluster capex numbers, as you rightly pointed out. So I think the lackluster investment cycle has already impacted some of these sectors in terms of the demand. And what we are envisaging going forward is slowly the private capex should also come up, not immediately, but once the capacity utilization levels will move towards the 80%, which may take maybe 24 to 36 months. But until then, there is enough economic activity that is happening in the country backed by the government capex. And that's what is going to drive some of those demand numbers for core sectors, in our opinion.
What about, when we're looking at broader markets, newer themes, Harsha, as well, what about insurance? That's of course something that we've talked about. Also, we've had, other niche themes like chemicals, for example, other financial names in the mid-cap basket that are standing out. What would be some of the newer themes that you'd be looking at?
We have invested quite a bit of portfolio corpus into chemicals over the last year or so, and continue to remain very, very positive on this space. I think it is one of those industry segments where the current ongoing US-China trade dispute is going to benefit from a longer term perspective. There are a lot of multinational chemical companies who are sourcing intermediates from China alone at this point of time, and they have clearly identified this risk and have started to move out of China in a meaningful way. And if India can capture some of that, and which we believe will happen in the chemical space, that will be a large export oriented growth that will come into the sector. And as it is, as of now, they are all running at full capacity utilization rate. So demand has been fairly strong, and we continue to see similar trend going forward even in the medium to long term for this sector.
Harsha, what could go wrong? And I will not allow you to answer globally something could go wrong, then markets come down. If some globally, that factor of risk factor is always there. But apart from that, what do you think could go wrong in your assumptions of economic recovery, demand, capex? Because when you are buying stocks, I'm sure you're working with a template and a model. In your template, apart from global factors, I say it again, Harsha, you're not allowed to use the word global risk. What else could go wrong?
I think clearly valuation is one risk, which is very dominant factor in case of large caps, at least at this point of time. And otherwise, if there is pressure on our fiscal situation, whether it is coming from crude oil or otherwise, I think that's going to put a lot of question marks in terms of government's ability to kickstart economic activity or continuation of economic activity, which means that you will have to wait for the recovery that we have all been waiting for last couple of years for furthermore. That's, I think, something that is not priced in at this point of time, because crude oil has been hovering in a narrow range and has been quite benign, and hence the fiscal pressure is not so high.
We're going to have to leave it there, I'm afraid. We've just got to go.